We've made it to the last panel of the afternoon. One thing standing between us and happy hour, so I'm excited to get started. This panel is called From Passive to Productive, Enabling Institutional Staking. We'll start with a quick intro from all of our speakers. Serafin, why don't you start?
Sure. My name is Serafin. I'm the founder and CEO of Yield XYZ. We are a yield aggregator, if you will. So we cover more than 30 validators that you can stake to through our unified API. And we cover about 1,500 DeFi yields. We're the largest yield supplier to companies like Ledger, institutional MPC wallets like Utila, launched earn sections through us. Fintechs like dBlock use us to bring stablecoin yields into the product. So yeah, an all-in-one yield solution.
Hadley?
Hadley Stern, Chief Commercial Officer at Marinade. Great to be here. We are one of the leading validator protocols on the Solana network. We have about 10 million SOL, so about 2 billion, depending on market prices. We were just talking about Friday, so I'm not sure where we are right now, but about 2 billion USD. We're the oldest staking provider on the Solana network, and recently very focused on helping institutions stake safely on Solana with our native staking product. Great to be here.
Brian?
Hey everyone, my name is Brian. I'm the co-founder and CEO of Course One. I've been interested in staking and involved in it since the very beginning. So I was CEO of Cosmos in 2017, which was one of the first proof of stake networks, and then created Course One about 8 years ago. And yeah, we were among the first to launch liquid staking. We were very involved in Lido in the beginning. We were at the very beginning there on Solana. And today, we work with a lot of institutional investors, a lot of funds, custodians, wallets, exchanges, liquid staking protocols, like all kinds of different parties to help them earn yield on their staking assets and actually also working on stablecoin yield as well.
Great. Mara?
Good to be here. My name is Mara Schmiedt. I'm the CEO and co-founder of a company called Alluvial. We focus on building institutional-grade staking infrastructure and are also the development company behind Liquid Collective, the first institutional-grade protocol that's focused on supporting liquid staking on both Ethereum and Solana with about close to $2 billion in assets on platform today. I too have spent probably close to as much time as Brian in the staking space, supporting the migration of Ethereum to proof of stake in 2020, and have since helped a number of companies, Bison Trails, Coinbase, and others, build staking infrastructure that is fit to meet both enterprise and institutional needs.
Speaking of institutional needs, I wanted to start with identifying what type of institutional clients are looking at staking right now, who's trying to get involved, and for what use cases. Hadley, did you want to take this one first?
Oh, sure. Yeah, institutions is a funny word, and we often talk about that, and I think we all have a similar challenge in how you segment, because it can be, a family office all the way up to an ETF and a whole bunch of different use cases in between. But I'd say broadly speaking, across all those different types of entities, very strong interest in staking. Especially on Solana, where you can get quite a high yield compared to something like Ethereum. But just as sort of the months roll by and there's more client understanding and institutional understanding of, typically the path is Bitcoin. Okay, I get Bitcoin. Now there's this thing called Ethereum. I understand proof of stake networks. Oh, there's also, not only can I invest in the underlying token, and I believe that will accrue value, but I can also do this thing where I can also earn at a protocol level, which is a lot of the education that we do, that this isn't a lending product or a financial product, this is a protocol product. And once you have those conversations, institutions are more willing to understand and listen. That said, I'd still say, like the rest of crypto, we're still quite early in this adventure. I would expect in the US, with the pending launch of ETFs and also DATs, we're going to see more and more institutions very open to this new asset class and way of earning.
Yeah, I want to get into DATs later for sure. Yeah, Brian, what are you noticing from institutional clients?
I wanted to maybe go to the DAT thing. I don't know if you want to go there later or.
No, let's. By all means.
Yeah, the DAT's obviously like a very new player. and it's something where there obviously has been a huge amount of capital flowing there, and I think the staking intersection is very interesting there too, right? Because I mean, if you look at strategy, like MicroStrategy, you know, he came up with this idea of like, what did he call it? Like the Bitcoin yield, right? Where basically just like how much more Bitcoin strategy could hold per share. And of course, the only mechanism to increase that was for MicroStrategy to, you know, either use debt or to sell shares at the premium to NAV, right? So that's the way he could increase the amount of sort of the Bitcoin yield and the amount of Bitcoin per share. But now we have, you know, Solana, and we have Avalanche, and we have Ethereum, and like many other assets of these stats. And they can then also stake it, and then with the staking yield can also increase the amount of tokens held like per share, and can do that at a, you know, faster rate. Then, so I think you have a strong incentive there to stake. Now, I think one thing that was very interesting was in Solana, there was a big debate and a big governance vote a while ago about changing the inflation, and Multicoin was, you know, pretty instrumental there in pushing for decreasing the inflation. And in the end, it was super close, but it didn't pass. But then, like more recently, you know, Kyle from Multicoin was like, "Oh, actually, that was a mistake. I'm happy it didn't pass." Because now, of course, they're running at that, and they're very happy that Solana has a high inflation, and that, you know, maybe makes it also very attractive for investors to hold these assets, because they feel like they're sort of compounding more quickly and accruing tokens more quickly. So I think it's a very, very interesting for that. And of course, one other thing that will probably, or it becomes much more of a topic for that, is also, you know, they need some kind of operating business, so they need to do something, and then like running nodes is one of the most obvious things that they can do.
There's so many. I feel like there's just been a huge explosion in DATs. We've been covering so many of them. I mean, do you think it's a bubble? Do you see more?
Yeah, it's definitely a bubble. I mean, well, it depends. I think it is something that's going to stay for the long term, and it's not going to go away, and I think some of them can become massive. And, you know, I was speaking with a project we invested in that's kind of like an early proof of work network, and even from the beginning, it's a very early stage project. He was like, well, our vision is to like IPO at some point, and then we'll hold a lot of tokens on the balance sheet, and we'll build things around this network. And it kind of makes sense to me. But I think you will need to do more, right? You need to do something that's interesting beyond just holding the token. Or like either I think you can be like the largest, and maybe you can just hold the token, and if you have a great, like, I don't know, Tom Lee spokesperson or Michael Taylor and stuff, but I think anyone else has to actually have some sort of operating business, do something interesting, and if not, I think they'll all die.
Mara, I see you nodding.
Yeah.
What's your take?
I think digital asset treasuries are a very interesting segment. Having been in the space for a while, I think what's unique about having public companies not just think about utilization strategies for stakeable assets, but actually think beyond that. I think it's maybe one of the first segments of like regulated market participants that we've seen think beyond just baseline staking yield and actually think about, if I want to increase ETH per share or SOL per share, what is the best mechanism for me to do that safely, whether it's in both the centralized or decentralized markets. And I'm finding that with that segment, we support a lot of the DATs that operate on Ethereum today, and it's been really interesting to hear them talk about, you know, how do I go from, you know, staking my ETH to actually being able to deploy it in DeFi? How can we get comfortable with that? What kind of risk frameworks can we build to actually build and maximize our utilization strategy? And it kind of paves the way for this adoption that we want to see, right? Gradually moving on chain and being able to build the right frameworks and the right strategies to support institutional adoption also and truly on-chain markets in the space. And so we've been pretty excited to see that. LSTs are obviously a massive unlock for that, because traditional staking, you stake the assets, that's kind of the end of your journey. I think with liquid staking, it becomes very clear that you start building other strategies around that, you know, become composable, that are compatible with DeFi utilization, that, you know, DATs appreciate as an option inside of their, you know, toolbox.
I kind of feel it's unfair and too early to call it a bubble. I think that there's a tremendous amount of creativity going on, and as you were alluding to, it's What's interesting about the DATs, unlike the ETFs, is there are more things that these DATs can do and really create this flywheel for DeFi beyond just holding the asset and staking it, which of course is important. So I think it's great. It's just starting. Will it be a bubble? We'll see. I guess if you're bearish on crypto, it'll be a bubble. But if you're bullish, maybe there's not enough DATs.
Serafin, how are you thinking about the DAT landscape?
I do believe that it's a bubble in terms of the amount of DATs that have come to market. I do expect there will be a lot of consolidation around the kind of like primary players. I do think it's a net positive because you just, for one, I think the DeFi adoption is something that is totally underreported because everybody essentially can run node infrastructure for these DATs, but how sophisticated you can actually deploy into DeFi is going to be a huge differentiator for these DATs. So access to DeFi is massive. The ability to intelligently allocate resources, that is a huge differentiator. And I think ultimately, if you have kind of like a centralized, you have very visible and large players, right? So I think, obviously like Tom Lee is somebody who's frequently on CNBC, and I think something that Arthur Hayes said at Token 2049 was that he's essentially like an unofficial spokesperson for ETH. They can say things on CNBC that anybody from the ETH Foundation couldn't say, right? And I think that holds true also for Forward Industries and Multicoin. I think the way that they're approaching kind of like seeding the entire DeFi landscape with Forward Industries is incredible. Transparently, they're also our largest investors, so I have to say nice things. But I do think that they're actually an incredible steward of capital, and I think ultimately it's going to be net positive, a huge net positive for the entire industry, can bring an entirely different angle into shaping the market than retail can or kind of like isolated institutions.
Definitely. No, it's a space to be watching for sure. I guess zooming out, kind of looking at institutions getting involved in staking, what role should staking play in institutional digital asset strategy? Mara, did you want to start?
Sure. I mean, it'll be table stakes, I think. The reason why I got excited about staking many years ago is because it felt like really the next frontier. You figure out how to hold digital assets, and then you figure out how to trade them, and then probably the next thing is like, what can I actually do with this thing? Staking unlocked a very new, relationship and also productivity that's not inherent to assets like Bitcoin, and I think that makes assets like Ethereum and Solana quite unique. And so I think as we continue to see the market evolve, more and more entrants are becoming part of that, right? In the first leg, you had a lot of crypto-native companies, crypto-native custodians, crypto-native exchanges supporting staking as just a table stakes part of their offering. I think now we're seeing more incumbents, more traditional financial institutions move into the space, whether it's Fortune 500 asset managers inside of ETFs offering staking because it inherently has to be competitive, not just with international offerings, but also in local markets. I think you're starting to see banking participants starting to pick this up, folks that have announced publicly their initiatives to start offering staking to their clients. I think you're starting to see retail platforms and retail brokerages that are more traditional start tapping into the space, people like Robinhood offering staking locally on their platform. So I think anyone that offers really digital assets that are stakeable on their platform will eventually have to build a staking offering around it. And I think then the question just becomes, what offering can you use that you can scale over time that meets your security and your compliance needs, and how can you evolve it from there?
With the traditional financial institutions that are coming in, are you seeing the interest in staking, is it primarily yield driven, or are they interested more in getting involved in the space?
I think it's a combination. I again find the DAT kind of universe quite interesting because it's a combination of people who are like inherently driving the community and education around digital assets forward. You have, unofficial spokespeople, if you will, that are educating the broader markets because they have the accessibility and awareness. And I think that continues to be incredibly important to have market participants that really drive forward education about digital assets because in many ways we're still really early. And at the same time, I think we do see, tangible interest in the, productive nature of these assets when it comes to, CFOs, treasurers, ultimately asset management clients that are trying to figure out how to get the most out of the assets that they've currently held passively on their balance sheets or inside of their portfolios.
Do you agree?
Yes.
You can disagree.
No, it's
Not controversial.
I have a thought
Yeah.
I disagree violently and vehemently
Okay.
with my colleague. No, I was just, one of the conversations that we often have at Marinade. So Marinade, we don't run any validators ourselves, and kind of our secret sauce, no pun intended, is helping people get the highest yield as possible, but also very importantly, helping continue to support the decentralization of the Solana network. Because it's very hard to run a validator in Solana. It's expensive and it's hard to get Solana to stake. So the conversation that we often have is, Solana is very aggressive about believing that Solana will be run NASDAQ on chain. And so if you believe that in the institutional space, then yes, the yield of Solana is great, but it's also very important to also continue to support decentralization. So the conversation we try to have from an educational standpoint, kind of a philosophical one, is around the importance of continued support of decentralization also in the institutional space. Because once activities become on-chain, you're going to need to have this healthy decentralized network to support those activities. And it reminds me, eons ago when I was at Fidelity, one of the first conversations we had getting involved in Bitcoin was if we were going to get involved with Bitcoin there, we should mine. And so it's the same with proof of stake networks. So yes, it's about yield. Of course, everyone wants a great financial product, but it's also about supporting the underlying infrastructure that's going to be part of our future.
Serafin, what's your take on how institutions should be incorporating staking in their strategies?
To be honest, I think staking is kind of table stakes for any institution that is in the space. I think it's kind of like them being in the space is a precursor to obviously staking. I don't think anybody's coming into the space to participate in governance necessarily. I think it's kind of if you place a directional bet on an asset and if you have exposure, long exposure, you might as well get yield on it. You might as well get the protocol level, the network level yield, right? Because if you don't, you're either not going to get distribution of revenues because there are no shareholders, right? There's only token holders, ideally. And then secondly, if it is distribution of inflation, then you might as well not get inflated out of a position, right? So I think it all starts with if you're involved as an institution, you have to stake. And I think ultimately our bet is still that ultimately liquid staking is going to eat the entire market because, as Mara correctly said, it's kind of like, liquid staking is just kind of like the precursor to then doing something else. So ideally the stack is you have an asset, you have base exposure, you stake it, you liquid stake it, you take the liquid staked asset and actually deposit that into a DeFi product, right? That's kind of like the ideal stack. And to be honest, I think that most institutions are really trying to understand what is the market rate for us to not underperform, right? And I think as we have more and more policies kind of like opening the doors for DeFi, you'll see that rate creep up and up. And so ultimately, that's going to force people's hands in terms of having to participate in DeFi. So I think ultimately they're going to get pushed further and further up in the stack, and we're pretty excited about that. Especially since, just to kind of like maybe touch on that too, the new crop of industry players, especially fintechs, etc., they don't think about staking. They don't think about DeFi yields. They just think about yield in the aggregate, right? So we have neobanking clients that came our way and said we want to offer ETH staking, right? Ultimately, we have 1,700 different yields that we support through Yield XYZ. They get access to absolutely everything, and we showed them, okay, here are all the 30 plus validators you can choose from. Here are the different liquid staking pools that you can choose from, etc. And ultimately, they landed on a Weth lending pool, right? Because any kind of exit queue is a total non-starter for them. Any type of minimum deposit amount is a non-starter for them. So I think for this next generation of institutions that are coming into the space, the concept of yields is totally abstracted away. And it's really about getting access to whatever is currently the best yield, be it a kind of composite multiple DeFi Legos or staking Legos put together, or some sort of new type of structured yield product they might want to get access to. So yeah, I think it's a starting point, and ultimately everybody's going to move much further, down the yield stack, and it's going to get super abstracted away. What is actually generating the underlying yield?
And the beauty of how these networks are designed is it doesn't matter what the intent is. Every asset that is staked contributes to public good, contributes to network security. So in the end, you have a fully synergetic life cycle, regardless of what is driving people or institutions to participate and ultimately adopt these products.
Definitely, definitely. I guess in terms of institutional demand, where it currently is, from an infrastructure perspective, are we there? Can we meet the demand? What challenges still exist? What innovations are happening? You all are definitely the people to be talking to about this. Mara, did you want to start?
So on the infrastructure side, yes, I think the market is maturing to recognize what kind of security postures are required. I mean, we've spent a lot of time building out a SOC 2 Plus like framework based on the various vendor diligences that both I personally, but also a lot of our clients have put a lot of node operators through to kind of standardize the space and provide, a clearer framework for risk assessment and security assessment when it comes to node operations. I think the infrastructure is there. I think, you have participants, including people on this panel, who've built and perfected their stacks and served clients for many, many years at this point. So it's not that, node operations or like staking infrastructure is just kind of sprouting out of the ground. I do think that the market has less of an infrastructure challenge, but more of a liquidity challenge in general. I think that ETFs entering the space, Grayscale officially started supporting staking last week, and then I think after the US government shut down, you'll probably have Fidelity and BlackRock not far behind. With that, you are starting to open the floodgates to, 10, 15, $20 billion of capital that could potentially be staked that has T+1 redemption requirements. And so the liquidity need for these types of market players is very different from what we observe on retail platforms or in other institutional segments. I think that's where the market gap is. I don't know that we've really scaled to liquidity providers in the incumbent markets that can take or absorb that type of liquidity, whether it's in credit arrangements or whether it's on the LST side. I think it's really more of a liquidity market question for me than an infrastructure and security one. But I'm hopeful that when demand shows up, supply will too. And so, I'm sure in the next couple of months, we'll see very different participants kind of entering the fold to really meet the demands that, the BlackRocks of the world will have.
Brian, do you agree that liquidity is maybe a more pressing issue than infrastructure?
Yeah, I agree with that. Yeah. I mean, I think when it comes to the sort of what makes it for like institutional grade staking provider? Well, I mean, first of all, even before the staking provider, a key consideration tends to be more on the custody side. So, especially in the US, they're like, okay, qualified custodian, which for a long time was really just Coinbase, BitGo, and Anchorage, right? And they basically, and I think they still very much dominate that market, but you do have a lot more players there, right? You have like Gemini, Kraken, Crypto.com, Fireblocks. Like there's a lot of new parties that have or are launching like qualified custodians in the US. So I think that landscape is also going to open up more. But so that's the first thing. And then of course, as a staking provider, you need to be like integrated there, or you need to work with those partners. Afterwards, there will be things like the contracts, so SLAs, insurance. But insurance, again, is something that has matured quite a bit, right? You can get like staking/slashing insurance, and like it's very possible. Then you have certifications like ISO or SOC 2, and then reporting. Reporting is also an important thing, and that's pretty hard, like to do reporting well. But it's also it's a solvable problem, and we have like a team that's just focused on that, right? And that has been working on that for a few years. So I think that's also pretty much there. So I think that covers that like pretty well. And then I do agree that the liquidity is a concern, right? So, and now even with Ethereum, right, the unstaking queues went like super high, and I think it's a concern it's obviously a concern for like ETFs, right, that have like legal redemption clauses, right, and the issue is also a little bit, I mean, you could say, well, just stake like 90% and, that should be fine, because when are you ever going to have more than 10% of the ETF redeemed like in a day? But then, the regulators will be like, well, but what about that scenario? And then so you have to kind of, which of course is very annoying, especially if you have to kind of pay for some sort of facility or provisioning that like you basically won't need. just to tick some box. But I think that is one challenge. But even on like, let's say the VC side or like the fund side, I think on the fund side, I do feel there's like a bit of a shift that's happening from having more VCs to more liquid funds, right? Because I think we've seen VC returns have not been so great. The amount of capital that's gone into VC has decreased a lot. And of course, also over time, some of these VC funds, they'll now have liquid tokens. They have to kind of manage that. So I think we see like way more liquid funds. And I think that is going to continue like that. I guess I think it's something, my understanding is, I don't know, maybe the other markets, right? You have like way more liquid money than venture money. But in crypto, that was reversed. And I think we're also probably going more to the side where VC industry is going to shrink a lot and you have way more liquid funds. So then you're still going to worry a lot about, how long the unstaking period is. Even let's say hyperliquid is a good example, right? Because the yield is not that high. It's like, 2.5%. Unstaking period is like 7 days. So then you're like, is it worth to stake? Because what if I want to sell? So like on that example, for example, we launched a validator there together with FalconX, and then, because they have like a regulated business and they can do this so they can also then like basically provide solutions for that. So I do think those kind of things, whether it's on-chain or off-chain, but solving for the liquidity issues, is going to become like even much more important. And then I think other things like, hey, you want to like borrow against your staked asset and use that as collateral for other things. Although, of course, hopefully you don't get blown up like, like some people did last weekend. But I think those kind of products will become much more important. So I think we are going to see staking more, become part of different types of financial products with different risk profiles and reward profiles.
I was just going to, to the extent that we can have controversy on a staking panel, even though Marinade's the first liquid staking token on Solana with MSOL, we have a very specific point of view that native staking is actually better for ETFs and certain types of institutions. There's no smart contract risk. And in Solana, you only have a 48-hour unbond time. But even in Solana, that's a problem. So something we've recently introduced is instant unstake, which is basically an RFQ market and it's open to any validator. So it's not on Solana, it's not just Marinade specific. But if you're an ETF and you want to exit within that 48-hour epoch, you have a market that you can go to liquidate that stake position. So I think there's still a lot of the things like SOC 2, which we also have, and insurance, which we also have. Some of those things are becoming commodified across the industry, which is actually a healthy thing. And now there's still room, though, for some innovations like instant unstake and other pieces that will allow the operationalization of different staking modalities for institutions.
Mm-hmm. I agree. I think the only thing I would flag for audiences that might be less familiar with this is that not all protocols are created equal. And so while Solana has a nicer, more tenable sort of window to liquidity, I think what we've seen on Ethereum in the last couple of weeks has blown through expectations in terms of how long the withdrawal queue can actually get. I think we're past 50 days. 50 days to withdraw assets changes materially the liquidity and the risk that people perceive, the institutional market specifically. So that, of course, impacts how ETFs view these assets, how they think about their thresholds. But it's not just the institutional segment. It's also a question of how do you help a retail user that is not crypto native understand that a week ago they could withdraw their ETH if it was staked in a couple of days, and now they have to wait for almost 2 months. That is a terrible user experience. And so I think we have to continue to innovate. And I think liquid staking tokens in many ways create flexibilities that can either live on the front end, but also on the back end to facilitate much more, user-friendly flows, both on the retail side, but then also in the institutional market landscape.
Serafin, I saw you nodding. How are you thinking about liquidity?
Yeah, I think this ultimately ties back into the question that you asked, if it's kind of like if the tooling is there for the industry. And to be frank, I don't think it is, right? Because a big part of the reason why the exit queue spiked so much in Ethereum is because Kiln got hacked. And essentially, they withdrew all of their validators from the active set, and so all of that was because a couple of key players essentially had Kiln as one of their, or the only staking provider, right, as the only option that people could stake to. And I think that's a huge problem for the industry. That's a non-starter for institutions. That's terrible in terms of centralization for the actual networks. And it ultimately ties back into the question who can actually afford to build infrastructure to be natively deployed, right? So I mentioned Utila, for instance, as one of the examples earlier, and they build an earn section through us. They immediately have access to 30 plus validators in the stake section. Any of their clients can compare validators side by side. They can pick and choose which one is right for them on any of the networks that are supported. And I think that is kind of like starting to become table stakes, right? And it should not be dependent on who actually has the resources to kind of like put in the, build the tooling or have the BD team to get exposure in these products natively. I think it should be fully meritocratic, and that's exactly what we're working on. So multi-validator access on the native staking side is critical. And then, of course, what Marinade and Alluvial are doing are kind of like at the liquid side, kind of like pushing in the same direction, right? And I think that's exactly where it should be going.
Hadley, I know you mentioned, we talked about liquidity, but I guess to go back to the point that Mara made, do you think is infrastructure a primary problem, or is liquidity more of a problem? Is the infrastructure there?
I think the infrastructure is largely there. We've got a number of very mature providers across the industry. We're just a 30+ team focused on Solana, but there are other great teams that are focused on multiple chains. But yes, we saw the unfortunate incident with Kiln. Things can come up, but I think the infrastructure, I mean, it's not easy to do, but people have been doing it for a long time at different companies. I think the liquidity challenges are going to be something different and this is where, LSTs can play a part. This is where we think instant unstake can play a part as well. But again, not very focused on Ethereum, but as an outsider, the infrastructure of Ethereum is not the reason why we have these, 30 to 50 plus days. It's other pieces of the network at the protocol level. So I'm not sure if it's liquidity or is it protocol challenges. So there are still challenges when you think about this actually working at scale, but we're all growing up along with the industry and providing those services.
I want to shift gears a little bit. So in terms of the current regulatory environment in the US and abroad, how are different regulatory frameworks or lack thereof influencing how institutions are thinking about staking? Is it a barrier to entry? Serafin, did you want to start?
Sure, yeah. I think with the new administration, to be frank, there's now a lot of clarity in terms of how institutions can access crypto markets. I think the repeal of SAP 121 was hugely important. The OCC, FDIC, providing clarity on charter trusts, being able to actually custody funds, that was extremely important. I think there's still some questions around, that's kind of like on the staking side, or like impacting the staking side in particular. I think that on DeFi, there are more questions. So for instance, stablecoins not being able to issue yield natively as part of Genius, but also like in MiCA in Europe. I think that's kind of like still a question. Obviously, Coinbase and others have been trying to find a workaround where essentially they're not the issuer, but they're paying additional yield from like a marketing budget or other budgets. I think ultimately what we're working towards is providing customers rails to as long as there's a legal framework to access yield directly within their products. So making it very easy for them to deposit tokens into DeFi yields, for instance, or staking them natively within the product. So I think ultimately it's great that we get more clarity, and ultimately that's of course like the guiding factor and the gating factor in allowing institutions to enter the market.
Hadley, how are you thinking about regulatory concerns?
I agree very much with your way of looking at it. That I think in terms of the core staking, at least in the US, we're quite good. There's some questions remaining about LSTs, but we're members of the Proof of Stake Alliance, which your co-founder basically founded and has been very helpful in the conversations over the years. And so when it comes to staking itself, divorced of the DeFi questions, I think we're in a fantastic position. We'll cross our fingers, see. I think the final ETF approvals will be the big wins across multiple protocols. But at least in the U.S., things are looking pretty good for staking. I think one of the things that the Proof of Stake Alliance did very well over and over again was just explain that this is not a lending product. This is not a financial product. Staking is the output of a protocol level activity that happens to have a financial reward. And you sort of drill that in over and over again and explain it, then eventually people get that.
Do you agree, Mara?
I absolutely agree. It's been incredibly interesting to see just the level of progress I think that we've had on the regulatory side, particularly in the US under the new administration, especially because, we started our company when the crypto climate in the US specifically was still, kind of lukewarmish, and then quickly turned pretty cold. It's unique, I think, for, startups, frankly, like Marinade and us in really early stages to spend as much time on policy education, lobbying, memos and regulatory conversations as we have. But I think it's absolutely been worth that level of engagement. I think now seeing where we've gotten to, I think we this year received regulatory guidance on staking. We had the SEC task force release guidance on liquid staking and the differentiation between ministerial and managerial aspects of these services that I think we've, with the Proof of Stake Alliance, but also on our side, have advocated for a very long time. And regulation has been by far the most material blocker to adoption, at least in the US, but I would also say in other markets. And so I think now we really have an opportunity to, innovate within the frames of clear guidance to ensure that we can build safer, more productive products, and to make sure that, entrepreneurs can focus on actually delivering value.
Just one caveat in case there's anyone from U.S. Treasury here. The remaining issue that's still challenging is taxation.
Yeah.
So that's really which is very complicated in staking. But apart from that, everything's pretty much
Tax
solved.
and accounting.
Yeah, tax and accounting, yeah. Kind of tied together.
There's a couple of sub-bullets there, but
Yeah.
we're slowly getting to our resolutions on these matters. But it's been really positive. Also outside of the staking space, as Serafin has already touched on, as it relates to stablecoin guidance and sort of material developments under Mika as well.
Definitely. We
Yeah.
only have a couple minutes left, so I want to end with a forward-looking prediction question. We'll say 5 years. 5 years from now, where do you see the institutional staking space? What use cases? How do you see demand increasing, involvement? However you want to take it. Who wants to start? Hadley, I think you want to start.
Okay, 5 years from now. So right now, we went pretty quickly in Bitcoin to about 6-7% of Bitcoin in ETFs, and then probably another big chunk percent. I don't know when you do the math, so maybe 15% of Bitcoin. I think it's going to be more on proof of stake networks. So I would say 5 years from now, maybe 25%. I'll be bullish of Solana, ETH, etc. Proof of stake networks will be held by institutions, and 99.9% of that will be staked.
Serafin, what's your take?
I agree with the staking ratio of ETFs for sure. And to be honest, again, I think that our thesis is that ultimately, like the entire market cap of any one token should probably be, I mean, this is an oversimplification, but directionally correct, should be staked or liquid staked. Ultimately, again, I think like 5 years down the line, we'll see a lot more abstraction. I think there's going to be a lot more smart infrastructure that allocates based upon performance metrics that is entirely objective, where individuals don't have to go in and actually assess individual providers themselves or individual protocols. It'll be fully automated. It might be agentic, but I think ultimately it's just about figuring out what is the best, like what is your risk profile and how much should you allocate in each bucket. I think all of that is totally underrepresented right now. Risk scoring for various different providers. On the staking side, it's actually okay, but in DeFi, it's very problematic. So anyway, I think that's going to emerge a lot more, and we're going to see a lot more automation.
Brian, what's your prediction?
Yeah, I think staking will, sort of vanilla staking will become a little bit less important, and it will become more like more complex products that, try to get higher yields as well. Like, to give an example, like you can imagine that you could, like, say you stake assets and maybe you borrow against it some like dollars because it's pretty low risk, and then that gets deployed in some sort of DeFi thing and it earns a higher yield and gets back converted into the staking asset. And like, you could do this sort of stuff yourself today, but it's kind of a hassle and there's some risk. But if you can just like automate a lot of this stuff and have it managed, it can actually work pretty well. So I think we will start to see like way more things like that, where again, I think for the end user, a lot of it will sort of get abstracted, a little bit like you have today when you put funds into some morpho vault, right? Where you don't exactly know what's going on behind it, but like, something, and you get like a bunch of yields. So I think staking will become more of a component of that, and it will really merge more with DeFi.
Mara, what's your prediction?
I agree with that. I think that staking probably will be viewed increasingly as just an alternative income stream that will, I think, continuously get more composable inside of institutional portfolios, not just digital asset or crypto-focused portfolios. I'm quite excited to see staking rewards passively pass through, pension funds and other structures that allow people to sort of have exposure and portfolio diversification, and also, frankly, the benefits of what staking provides, which is effectively uncorrelated yield effectively unrelated to monetary or sovereign policy. And I do think that we will be resolving a lot of the, frankly, regulatory, accounting, and tax challenges related to like institutional participation in DeFi, which I think will, create the breeding ground for a lot of the convergence that I think other people on the panel have spoken about, where, staking rewards become a baseline component of other composable strategies, and, more and more participants in the market will feel comfortable to sort of bridge into that and participate in DeFi holistically.
It's definitely a space to watch. Thank you guys so much.
Thank you.
Thank you.